All right, good morning, afternoon, evening, whatever time of the day, as usual. You're going to be listening to this PowerPoint. All right, so today we're going to go into chapter 2, a further look at the financial statement. We have three major objectives for this class, or for this lesson. We're going to identify the sections of the balance sheet. We're going to use ratio to evaluate a company's profitability, liquidity, and solvency. And then we'll discuss financial reporting concepts. So it's a little bit light, okay? I remember we talked about the four financial statements in our last class. We talked about balance sheets. We talked about the income statement. We talked about the statement of returned earnings. We also talked about the statement of cash flow. For the purpose of this lesson, chapter 2, we are going to be looking into the balance sheet in a little bit deeper detail. Okay? So the classified balance sheet. The classified balance sheet presents a snapshot at a point in time. It gives you a picture of what the business is, or the state or the health of the business at a particular point in time. When we look at the classified balance sheet, it helps to improve understanding of what the company is all about. And most times, companies group similar assets and similar liabilities together. Okay, this is useful because items within the groups have similar economic characteristics. The grouping helps users determine whether the company has enough assets to pay its debt, or what claim by short-term or long-term creditors exist on the company's total assets. Now, how are these assets being categorized? We start with the current assets, and then we go to long-term investments, and then we go to the property, plants, and equipment, and then intangible assets. So for the asset section, it goes in this order: current asset, long-term investment, property, plants, and equipment, and then intangible. And then for the liability and stockholders' equity, it starts from the current liability, the long-term liability, and then the stockholders' equity. Okay, so this is an example of the classified balance sheet. We have the current assets listed, right? And then the different types that we have here: the cash, debt, investment, accounts receivable, notes receivable, inventory, supplies, prepaid insurance, and that gives us total, that skipped the page. That gives us our total assets. And then we have the long-term investments, okay? We have the stock investment and then investments in real estate. Our total here is 7,200. We have our plant, property, and equipment. I always start with plants. But property, plant, and equipment, PPE, as we'll often hear it to be called. We have land, equipment. We're going to deduct our accumulated depreciation, and that gives us 29,000. Okay. Intangible asset, a good example for this company, Franklin Corporation, is patents, and that is 3,100 for a total of 61,400. How many of us remember the accounting equation we talked about last class? The one I told you to put under your pillow or up above you when you wake up in the morning. That's the first thing you see. It's something that you want to keep and have a deep understanding of. That the assets will always equals to your liabilities plus stockholders' equity. Okay? So for the total assets here, we see that we had 61,400. And the addition of our liability and stockholders' equity also gave us what? 61,400. But we see how they arranged it in order. We have the current liabilities, we have the long-term liabilities, and then we have the stockholders' equity. Okay? Nature of current assets. All right, so our current assets are assets that the company expects to convert to cash or use up within 1 year, or the operating cycle, whichever is longer. So if an asset is able to convert to cash within the operating cycle or within 1 year, we're saying whichever is longer, then we call it what? A current asset. Now, common types of current assets, we have cash, of course, short-term investments, we have receivables, it could be accounts receivable, notes receivable, or interest receivables. We have inventory, prepaid expenses. These are examples of current assets. And then when we talk about operating cycle, we're saying the average time it takes from purchase to inventory, to sale of goods, and then to collection of cash from customers. So we're talking about that operating cycle, okay? From the time you purchase your inventory to the time you sell the goods to the time you collect your money from the customers, whichever one is longer, okay? That is termed as current assets. Okay, so this is an example of how current asset is prepared, and we always want to arrange them in order of liquidity. When they're on the balance sheet, you are going to arrange them in order in which you expect them to convert into cash. So under the current assets, we have the cash and cash equivalents, then the short-term investments, then accounts receivable, inventory, prepaid expenses, and then you have the total. We add up everything. Again, you always want to remember that the current asset is arranged in order of liquidity. Okay? Then the long-term investment in stock and bonds of other corporations that are held for more than 1 year. So you buy stocks in another company, or you have bonds of other corporations that are held for more than 1 year. Okay, that's going to be termed a long-term investment. Long-term assets such as land or building that a company is not currently using in its operation. Okay, so long-term assets such as land built that it is not currently using in its operation now. And then we have long-term notes receivable, more than 1 year or more than an operating cycle, whichever is longer. Okay. All right, so long-term investment presentation, long-term investments. For this Alphabet Inc., we have long-term investments. Non-marketable investment, 5,183. Now, what's the nature of plant, property, and equipment? Okay, it comes under plant, property, and equipment. They're assets with a long, useful life, and they're usually used in the operation of the business. Okay, the other one we talked about, they're not used, and that's why they came under the long-term investment. This also includes land, building, equipment, delivery machines, furniture, computers, whatever you use in operating, right? That has a long life, has a long useful life. Okay, we're going to term that as property, plant, and equipment, and they're usually depreciated. Okay. Many times when we think about depreciation, we think about value. But I want us to know that when we talk about depreciation here, we're talking about cost, allocating the cost of the equipment through a period of years. So what example? Let's say I buy a computer or a machine that I use in my business. I bought it for 100,000 or 50,000. Let's assume 50,000. And I'm going to divide that 50,000, right? Say I'm giving it I want to pay it off, let's say in 5, 6, 7 years. I'm going to divide that by 5. Assume I'm going by 5 years. So 50 divided by 5, that means every single year I'm going to expense how much? 10,000. That 10,000 that I expense every year is what we term as what? Depreciation. Okay. Now, because I expense 10,000 every year, for us to get what our accumulated depreciation is, from our definition here, it says the total amount of depreciation expense to date in an asset's life. So how much have I expensed after 3 years? If I pay 10,000 every year, that's going to be what? 30,000 accumulated depreciation. Your accumulated depreciation shows up in your balance sheet, right? Whereas your expense for that year or for that month, depending on what your operating, your calendar year is, that is going to show up in your income statement. Okay. All right, so this is an example: property, plant, and equipment, land and improvement, building, machineries and equipment, with their numbers. We have less accumulated depreciation, and that gives us, we deduct it to get 864, 227. Okay, so this is our plants, property, and equipment in the balance sheet. Okay. Nature of intangible asset: assets that do not have physical substance, including goodwill, patent, copyright, trademarks, and trade names. Okay, all those don't have tangible physical substance, but they add to the value of the business. So sometimes intangible assets are reported on a broader heading, and sometimes it's usually called what? Other assets. So this is an example. We have the character, franchise intangibles and copyrights, other amortizable intangible assets, accumulated amortization, net amortizable intangible assets. These are just examples of intangible assets. Now, when we talk about amortization has the same idea as the depreciation. Just that the word amortization is used for intangible assets, whereas depreciation is used for tangible assets. Okay, so we're doing our exercise 1, asset section of a classified balance sheet. Baxter Hoffman recently received the following information related to Hoffman Corporation, December 31st, 2022. Balance sheets. Okay, this is the balance sheet. We have the prepaid, inventory, cash, equipment, accounts receivable, trademark, debt, investment. We have accumulated depreciation for equipment. We are told to prepare the asset section of Hoffman Corporation classified balance sheet. At this point, you may decide to pause, try it out, try to do your balance sheet, and see if you arrive at the right answer. All right, so the first thing we're going to have under assets, remember again, we arrange our assets in order of liquidity. So we have our current asset, we have cash, followed by accounts receivable, followed by inventory, prepaid insurance, and then we have our balance for our assets, current assets. Then we have long-term investments, we have the debt, investment, we have plant, property, and equipment. Equipment is 10,000. I remember we had depreciation, or we had accumulated depreciation, which we deduct. That gives us a balance of 8,000 on the plants and property. Then we have intangible assets, right? For this one, we have only trademark, and that gives us a total of 22,400, okay, in assets. Now, if we had a second part to this question, or we're doing it as a real company, again, our assets will equal to liability plus stockholders' equity. Now, nature of current liabilities: obligations the company is to pay within the next year of operating cycle, whichever is longer. Okay, so whatever you have to pay, right, that you owe, that's within a year or within an operating cycle, whichever is longer, is tend to be a current liability. Examples of common liabilities are accounts payable, sales, wage payables, note payables, interest payables, income tax payable. So I go to my class, all the payables, okay, you want to know that they are called liabilities. So, and current maturity of a long-term obligation, payment to be made within the next year on long-term obligation. So if there's anything, for example, you owe a note, right, and that note you have to pay it off within 5 years, but every year you're supposed to make payment on it. The payment that is current and due now will be current, okay, and then whatever you have to pay within the next, maybe next year or upper years, is going to be long term, okay. All right, so this example: short-term debt, accounts payable, accrued compensation and benefits. Oops, what is accrued? We will get to that in chapter 4. Okay, accrued expenses and other current liabilities, income tax payables and net. And then all of these are examples of our, current liabilities. Obligation, that's nature of the long-term liabilities. Obligation a company expects to pay after 1 year. So more than 1 year, all right, or the operating cycle, whichever is longer. This includes bonds payable, mortgage payable, long-term notes payable, lease liabilities, and pension liabilities. Okay? Long-term liabilities. This is an example of how it shows. This is for Nike. Bonds payable, deferred income tax and others, and then long-term liability. Okay? Then under the stockholders' equity, we have components of stockholders' equity. We have the common stock, and then we have the retained earnings. For the common stock, we have investments of assets into the business by stockholders, right? The shares which the stockholders buy, okay, will be classified under the common stock. And then the retained earnings, these are income for use in business, which you decide to put back in, rather than distribute. Okay, it's going to be found in the retained earning in the balance sheet. Okay, this is an example for us to do. Match each of the account names on the next slide to its proper balance sheet classification shown below. If the item would not appear on the balance sheet, use NA. So we're going to look at all of these and find out which one goes to the balance sheet. And if it doesn't belong to the balance sheet, we want to put a NA. Alright, match each account to its proper balance sheet classification. If the items would not appear on the balance sheet, use NA. So we have account name, salary and wage payable. Okay, where would that go? Current liabilities. Investments in real estate. What do you think? Long-term investments. Unearned service revenue. Where do you think that will go? That's current liability. So I'm going to explain that real quick. My greatest example, or what I always use as my example, is for unearned service revenue. If you decide to travel, say from San Diego to Texas, and you pay for your flight, say you use whatever airline you decide to use, okay? You pay the airline this to travel from San Diego to Texas, and you paid a month ahead. You have made payment to the airline, but the airline has not performed that service to you. And because they have not performed that service to you, it is a liability to them. And that's what we term as unearned service revenue. That is services that you've paid for, which the company has not yet performed. Okay? So to the company, that's a service, unearned service revenue. And to them, it is a liability because they owe you, because that service has not yet been performed. Okay? We're going to deal with it in the subsequent chapters. Debt investment, what do you think that would go? Current asset, good. Mortgage payable during 3 years. 3 years. Long-term liability, perfecto. Accumulated depreciation. Plants, property, and equipment. Alright, so balance sheet classification. Still continue. Service revenue. Not a balance sheet item. Where do you think it's going to go? Income statement. Okay. How about interest payable? Current liabilities. How about goodwill? Intangible assets. How about depreciation expense? Not a balance sheet item. So what financial statement do you think it goes to? Okay, I hope you said income statement. Okay. Anything expense and revenue show up on your income statement. All right, retained earnings, stockholders' equity. How about equipment? Property, plant, and equipment. Yeah, I got that right this time. Okay, learning objective 2. Use ratios to evaluate a company's profitability, liquidity, and solvency. All right, analyzing the financial statements using ratios. Ratio analysis expresses the relationship among selected items of financial statement data. Okay, So you're expressing the relationship among the selected items. You're looking into it. The ratio helps you um, to be able to discern or understand the relationship between items, right? It helps you to know how sick or how well a company is. Okay, so through the use of financial ratios, you are able to really look into the business and find out how it's doing. Again, the single ratio by itself is not meaningful. Okay, so you don't just pick a ratio. Oh, this is the number I have, 2.3. You always want to compare it. Okay, we're either comparing it with um, the company itself over the period of years, or you're comparing it with other industries or your competitors. Okay, so there's always a basis for comparison. Now, what are the ratio analysis that we can do? We have the profitability ratios. This measures the income or operating success of a business for a given period of time. Okay, so we have the profitability ratio. We also have liquidity ratio, measures short-term ability of the company to pay its maturing obligations and to meet unexpected needs for cash. Okay, you want to be able to find out if this company is able to pay its short-term, okay, obligations through the accounts payables. Are you able to pay? Are you able to pay salary and wages? Are you able to pay for maybe the inventory that you bought that you've not paid for within the short time? Okay, that's the liquidity ratio. And the solvency ratio has to do with measuring the ability of the company to survive over a long period of time. Okay, the ability for the company to survive over a period of time. Stability ratio. It measures the net income earned on each share of common stock. It's often called what? EPS. Now we're going to say that it's usually not advisable for you to compare your EPS within two companies because of the outstanding shares. So usually you have a best or better result when you compare the EPS with itself. So like over years, 2016, 2017 of the same company, or 2018, 2019, like you're comparing within the years within the same company. The higher the earnings per share of a company, the better its profitability. Okay? The higher the earnings per share of a company, the better its profitability. All right, so how do we calculate our earnings per share? Net income minus preferred dividend divided by the weighted average common shares outstanding. So we have our net income minus the preferred shares. So in this case, we don't have any preferred shares. Divided by the 2 years, the beginning outstanding shares and the ending outstanding share. Divide that by 2 and divide by the net income, and that gives us 3.8. Now if I want to compare accurately, I'm comparing 2016 and 2017. I'm saying that we did a lot better right in 2017 compared to 2016. Okay, like I said, the higher the better. Use a classified balance sheet. I think go through the balance sheet and in order to calculate the nature of liquidity. Like all the ratios that would do, solvency, profitability, the financial statements are what you use in order to get your ratios. So the ability to pay obligations expected to become due within the next year or the operating cycle. Okay, so working capital is the difference between the amount of current assets and the amount of current liability, calculated as current assets minus current liability. So in the balance sheet that we had before, right, we have our current liability and then we have our current assets. Okay, current, not total. Current assets and current liability, and that gives us 3,394. So at least we know that Best Buy has the ability to pay for its its short-term liabilities, right? Because it covers it. It's more than. If it's less than, like if you had the amount you're getting in negative, then that doesn't speak so well, because it may show, it could be a likelihood that they don't have the ability to pay off their current liability, short-term liabilities when it comes due. All right, so again, another liquidity ratio that we have is the current assets. People find this to be a little bit more dependable and reliable compared to the working capital that we just did. So the current ratio measures of short-term ability to pay obligation, just like the first one we did. It's computed by dividing your current asset by your current liability. It's a more dependable indicator of liquidity than the working capital. Does not take into account the composition of current assets, like slow moving inventory versus cash. Okay, so here we have for 2017, comparing them both, we have 1.48. Okay, here we see that they have the ability to pay. For every 1.4 cents they can pay, right? This, $1. Okay, for 1.4 cents they can pay $1. So for every dollar of current liability, Best Buy has the ability to pay this. So in 2017, you see they did it's a little bit better compared to 2016. But any creditor willing to maybe borrow their money on the short term looks at the balance sheet and they're able to say, oh yeah, well, they'll be able to pay. They got it. Okay. So solvency, the ability to pay interest as it becomes due and to repay the balance of a debt due at its maturity. Okay, so solvency ratio measures the ability of the company to survive over a long period of time. So when we talk about the solvency ratio, we are looking at the ability of the company to last a long time. So if you are that person who wants to buy shares in a company, okay, you want to be looking at the solvency ratio, because you don't want to put your money in a company that is going to, die tomorrow. So you want to be calculating the solvency ratio. How do we calculate our debt to asset ratio? We have total liabilities divided by total assets. Total liabilities divided by your total. So the other one we did was current versus current. So current asset divided by current liability. 2017. Okay. We have in the financial statement we see that our total liabilities is 9,147, and for our current total assets, total assets, we have 13,856. That makes it 66 cents. $66, sorry. And in 2016, we have it to be 68. So the 2017 ratio means that every dollar of assets was financed by 66 cents of its debt. So you're looking at its ability, right, to last for a long time. Evaluating cash flows. Cash provided by operating activities, and usually find them in the cash flow statement. Okay, this fails to take into account that the company must invest in new property, plants, and equipment, and must maintain dividend at current levels to satisfy investors. So when we deal with the cash provided by operating activities, we're saying that it doesn't take into account the fact that you have to buy equipment, that you have to pay dividend. Okay, it just assumes that this is the amount of money that you actually have. So describe the net cash provided by operating activities after adjusting the capital expenditure and dividends are paid. So in order for us to calculate our free flow, we want to know what is the net cash provided by operating activities, and we're subtracting capital expenditures minus cash dividends to give us our free cash flow. Okay, so every business that operates always want to have cash. You don't want to be a business that operates and don't have cash in hand to meet your obligations. Okay, so MPC produced and sold 10,000 personal computers this year. It reported 100,000 cash provided by operating activities in order to maintain production at 10,000. Okay, computers. MPC invested 15,000 in computers. It chose to pay 5,000 in dividend. Calculate the free cash. Net cash provided by operating activities 100,000. Expenditure on property, plant and equipment 15. Dividend paid 5,000. Free cash flow 80,000. All right, so do you want to pause and see if you can calculate the free cash flow based on the information that we have, or all the questions they want us to ask? So take time, pause, solve them on your own first, and then see if you got it. If you don't get it, then once you see the answer, you're able to know why you missed it or you didn't get it. You missed it or you got it. Okay. All right, compute earnings per share for 2022 and 2021 for Ozone primary competitor Frost Corporation had their earnings to be this. Okay, so we're supposed to calculate. All right, so our formula for earnings per share is the net income minus preferred shares divided by the average of the outstanding at the beginning and at the end of the same year. Okay, so divided by 2 and divide by the net income. So in year 2022 we have $1. For 2021 we have 80 cents. Okay, all right, we are supposed to compute the current ratio and debt to asset ratio for the year. Compare the answer you got with what we have here. Current ratio is current asset divided by what? Liability. So there we go. So for every $2.2, it can pay 1. That's good. Okay, same here. So then it looks like they're able to pay their current liability. Debt to assets ratio, there we have our total liabilities divided by total assets. And let's see what we have. 30%. That looks good. Okay, and that's it. 44% for 2021. And now we're going to calculate our free cash flow for each year. Okay, we have our net cash provided by operating activities. We have expenditure on PPE. We have preferred dividends. We have common dividend. Once we solve all that, we get our free cash flow. For 2022, we have $50,000. And for 2021, we have 37,500. All right, so that brings us to discuss financial reporting concepts. Okay, all right, standard setting environment, generally acceptable accounting principles. These are like a set of rules and practices. Having substantial authoritative support, and that the accounting profession recognizes as a general guide for financial reporting purposes. So this is just like a guide, okay, for us to follow, so that everybody, for most companies, we're all on the same page, and determined by standard setting bodies. Okay, so generally acceptable accounting principles. Okay, standard setting bodies, we have the Security Exchange. This is a U.S. government agency that oversees U.S. financial market and accounting standard setting bodies. We have the Financial Accounting Standard Board, often known as FASB. The primary accounting standard body in the U.S. is the Financial Accounting Standard Board. Okay, we also have the International Accounting Standard Board. Okay, this sets standard called International Financial Reporting Standard, that's IFRS, for many countries outside of the United States. All right, we also have the Public Company Accounting Oversight Board, often called the PCAOB. They determines auditing standards and reviews the performance of auditing firms. Okay, so for the international one, the IFRS, we have over 115 countries that use the IFRS standards. All right, so qualities of useful information. Okay, FASB states that useful information has to possess 2 fundamental qualities. Number 1, it has to be relevant. And number 2, a faithful representation. When we talk about relevance, we're also talking about materiality. A company's specific aspect of what is relevant to them. Okay, so for what is whatever they term to be material. An item is material when its size makes it likely to influence the decision of an investor or a creditor. Okay, so if you're providing information, right, to people, or you're providing information to the general public, if it's gonna be a big influence on decision making, or if it's gonna mislead, then you want to put it in there for them to have it, okay, to see and to understand. Relevance makes a difference in business decision, provides information that has predictive value, has confirmatory value, confirms or corrects prior expectations. Also, for it has to be faithful representation. That's the qualities of useful information. Okay, information accurately depicts what already happened. Okay, so you're giving us a precise, accurate information of what happened, not something that you're expecting to. All right, information must be complete. Nothing important has been omitted. It has to be neutral, not biased, not cooked up, and it has to be free from error. Okay, because these are all information that people are going to be depending on. So we cannot afford to give wrong information so that people don't depend, right, on something wrong and then get beaten later on for making that decision. So how are we able to enhance the quality of useful information? Comparability. When different companies use the same accounting principles to make a comparison, companies must disclose the accounting methods which they use. Okay, so we should be able to compare. Okay, information is verifiable. Information that is proven to be free from errors. Okay, if independent observers using the same method obtain similar results, so it should be verifiable. Information has to have the quality of understandability if it is presented in a clear and concise fashion. Okay, it also has to be consistent, which means that a company uses the same accounting principle and method from year to year. Now, if you have to change, okay, you want to put it in the notes to the account and tell us reasons why and what effect that change has on the financial statement. For us to enhance the quality of useful information, information has to be timely. For accounting information to have relevance, it must be timely. Okay, if it's not timely, decision makers may not be able to make timely decision, and that could be a loss of business either for you as a company or even for them. So what are the assumptions and principles of financial reporting? Okay, to develop accounting standards, the FASB relies on the following key assumptions and principles. So number one, monetary unit assumption requires that only those things that can be expressed in money are included in accounting records. So the only thing we want to use to calculate, right, is things that can be expressed in monetary terms. You don't want to see, I gave out 5 apples and 5 oranges and 5, those are not things that we can easily compare with, right? So it only has to be expressed in monetary terms. Then economic entity assumption that states that every economic unit can be separately identified and accounted for. Periodicity assumption states that the life of a business can be divided into artificial periods. Okay, for some periods it's divided into monthly, quarterly, annually, depending on the needs of the business. Now, the another assumption is that it's a going concern, that you start in the business with the assumption that it will operate for the foreseeable future. Okay? Now, what are some of the principles in financial reporting? Okay? Measurement principles. GAAP generally uses 1 or 2 measurement principles: the cost principle or the fair value principle. Okay? So, historical costs dictate companies record asset at cost. Okay? Also known as the cost principle. Alright? The fair market value indicates that assets and liabilities should be reported, okay, at fair market value. For our balance sheet, we always record our asset at cost. Okay. Now, many times when people now want to sell, they want to find what's the fair market value, and are able to sell off the items, at a fair market value. Full disclosure principle requires disclosure of all circumstances and events that will make difference to the financial statement user. So you want to be able to disclose anything, right, in the financial statements, right, that could affect or make a difference. Okay, so like the method of inventory evaluation, what method for depreciation, if you changed it, you want to put a full disclosure, let people know this is what happened and this is the effect that it has on the financial statement. Then we also have the cost constraint principle. Accounting standard setters weigh the cost that the company will incur to provide information. So the benefit that financial user will gain from having the information available. Okay, so you are trying to determine whether the cost the company will incur to provide the information will outweigh the benefit that the financial statement user will gain from having the information available to them. All right, that brings us to the end of chapter 2. I hope I added a little bit of clarity to the chapter. If you have questions, concerns, please show up for the office hours Thursday, 1 o'clock, 12 o'clock to 1 o'clock. Thank you so much, and thanks for listening.